we are particularly delighted today to have the seminar today from Dr. Juan Castañeda, not only because of the topical issue that he's going to address today, which is indeed contemporary, looking at money and inflation and the inflationary effects of COVID-19, but also because we were lucky to get him to speak. He's a distinguished scholar, and maybe let me just introduce him kind of formally. Juan is the director of the Institute of International Monetary Research at the University of Buckingham, and he has contributed quite a lot in terms of research in the areas, especially of monetary policy and central banking. He has worked with the European Parliament's Committee on Economic and Monetary Affairs, and also submitted, evidence or testimony for the UK Parliament report on the euro. So he's, interfacing very heavily using his research on impact for research to have impact on policy and practice. He's been an honorary senior visiting fellow in the Cass Business School, University of London, and also a visiting researcher at the Center of Monetary and Financial Alternatives at Cato, the Washington, D.C., and also UFM University in Guatemala. He's a very prolific person, with many high-profile articles and with books, and is review editor of Economic Affairs. So interfacing with the policy is a part of his day-to-day business. No wonder he's choosing this very topical aspect in which he's going to interface with that. And his CV is very long. I could go on reading very long. But one aspect I am very proud to mention here is that he's a member of the Institute of Economic Affairs Shadow Monetary Policy Committee. So he's speaking in time both from his research, but also from interface with some of the policy challenges today, including the challenges we have with the managing money or monetary policy in the COVID-19 era. Juan, you have the floor.
Well, thank you very much for your very kind words, very kind introduction indeed. So thank you for your invitation as well, Victor, to participate in this series. I'm delighted to be able to give a talk to your audience. Some of them I know very well, and I've learned from many of them in the past. And so it's a pleasure for me to be here. And also to Menxie, she's been really helpful and supportive in establishing all the details there of the webinar. So thank you both very much. I'm delighted to be here today. If only online, let's hope that we can make it face-to-face soon. So I'll try to share the screen so we can follow the presentation. If there is any problem, please just let me know if there is any problem with the slides or the connection, please.
It's fine, yeah, you can see it's fine. Thank you.
Thank you. So I will be making a presentation for 35-40 minutes, and then I will be very happy to discuss with the audience the topics that I'm going to present today. The overall topic is about money and inflation. It's a very classic topic that is becoming more and more fashionable these days, especially after March 2020. And in particular, I will try to answer the following question: will the responses given to COVID-19 crisis be inflationary over the medium to long term? That's the question that myself and my colleague from the Institute of International Monetary Research, Tim Condon, addressed in a paper that I have to say up front that it's not an academic, a conventional academic paper. It's a policy paper that we produced last spring, and it was published by the IEA on this very topic. And the motivation of this paper was that we were sort of alarmed of the very high rates of growth of money already since March, April, and May last year. And based on the sorry, there's a bit of noise in the background. I don't know if it's myself or somebody else.
I think we've checked it now. Yeah, okay.
Oh, thank you.
Yeah,
sorry for that. So what I was saying is we were very much alarmed by the extraordinary rates of growth that we were registering already early in the spring. And what we did in this report is to put together some empirical analysis in order to foresee the consequences of this extraordinary rate of growth of money since March 2020. So you can have free access to the publication online. It's on the website of the IEA. But the caveat is that the data that we had at the time was very much that available until April, May, perhaps last year. So if you want a much more up-to-date analysis of the potential inflationary impact of COVID-19, I would recommend you to visit the website of the IMR. So one of the things that we state in the paper is that COVID-19 was and indeed is a different crisis as compared to, for example, the global financial crisis. COVID-19 at least started as a massive and negative supply shock to the economy. That at the time we thought that it was going to be temporary, and thanks God now we know that slowly but safely we are coming out of it because of the rollout of the vaccines and other measures. We are indeed, finding the light at the end of the tunnel, as if it were. So it was a negative supply shock, but indeed with effects on aggregate demand too. If we follow any conventional mainstream macroeconomic model, what we know is that after a negative supply shock, we will be expecting inflationary pressures in the economy. Why? Because there is a scarcity in the production of goods and services relative to demand, and that would be the first dominant force in markets and inflationary pressure. Which was the response of policymakers to this crisis as compared to the global financial crisis? Well, it was a much more active and timely response by both treasuries, fiscal policymakers, and by central banks, the monetary policymakers. So in the very early days, once we knew about the COVID-19 spread all throughout the world, we had the combination of very expansionary fiscal policies to support income and businesses that produced enlarged government deficits. And most of those deficits were financed by the national central banks, by the banking system, but most of all was financed by the national central bank. So we have a combination of an expansionary fiscal policy and a very expansionary monetary policy too, in the form of new lending facilities to banks, extended and with a greater amount of money ready to be lent out to the banking system, and also the resumption of enlarged QE programs, asset purchases programs. And as I said before, mostly in the form of public bonds, national government's debt. And as another distinctive feature from the global financial crisis, this time regulators eased bank regulation. Rather than imposing higher capital ratios, for example, or liquidity ratios to banks, what the regulators all across the world did, of course, in a different way in different jurisdictions, but overall, they allowed banks to use the money they were lent out by the central bank to lend it out to the rest of the economy, rather than increasing capital ratios as they did in the global financial crisis. The consequence of these responses to the crisis was the monetization of the enlarged deficits by governments, resulting in extraordinary rates of growth of money. By money, I mean money broadly defined, including bank deposits. So I'm not referring here to narrow money, just the monetary base, cash and bank reserves in the central bank. No, I'm referring here to cash and also the liabilities of the banking sector, bank deposits. in most leading economies and overall in the US, that's the leading economy in this regard, we saw an extraordinary rate of growth of money, broadly defined. Indeed, in the USA, it reached up to 25% rate of annual growth, and that's the highest. That was the highest rate of growth in modern peacetime in the USA. That's how extraordinary it has been. And that did not happen in the aftermath of the global financial crisis. This is very unique of the COVID-19 crisis. So what we addressed in the report is if this extraordinary rate of broad money mattered at all as regards inflation and nominal spending along the cycle. Well, at that time, at the time of the writing of the paper, of the policy paper, the consensus about the effects of the crisis were quite the opposites as the ones we highlighted in the report. The consensus was that the crisis was going to have medium to long-term disinflationary or even deflationary effects in the economy. Not just a one-off disinflationary period, but medium to long-term disinflationary trends in the economy. And as I said, even deflation. However, as soon as we got new information about rising commodity prices and production prices by the end of 2020 and in early 2021, some of this consensus changed, and some of my colleagues, other professional economists, academics, international organizations, they started to revise the inflation forecast upwards. But again, the consensus in March, April, May, and June was very much that it was going to be a deflationary crisis. The other element in the consensus in the economics or economists' profession was that the rate of growth of money was not that relevant in explaining inflation. Why? Because if we looked back into the experience of the aftermath of the global financial crisis, indeed, central banks engaged in QE, and quite to a large extent, and that did not produce inflation. Actually, the problem we have had in the past was a problem of too low inflation for too long. So what we did is to try to tackle both elements in the consensus at the time by showing that indeed this time was different. Here you have a diagram with the CPI inflation rate in the USA. That's the bold black line, and the shaded area is the monetary base in the US, the Federal Reserve monetary base. So you have a combination of rates of growth, CPI inflation rate, and volumes. That's the monetary base. So as you can tell, there has been, especially since the aftermath of the global financial crisis, an increase in the monetary base in the USA, a massive increase in the last few years, and that did not come with any form of inflation, no CPI inflation at least. So we had a combination of an expansion of narrow money, or the monetary base, the central bank balance sheet, with no CPI inflation. However, this time, what we had is very much an increase in both the monetary base and also the amount of money broadly defined. If we look back at the USA experience in the aftermath of the global financial crisis, now you have two lines. One, the gray discontinued line is M3 growth. So it's a broader definition of money, including bank deposits. And now the solid line is the monetary base in terms of rates of growth. If we pay attention to the global financial crisis years, just the aftermath, 2008 to 2010, we can tell that indeed the monetary base increased quite notably, up to 8% on an annual basis in 1 year. That's quite a lot. But at the same time, the discontinued line, the broad money line, did fall and actually fell into the negative territory. So that's what explained, in our opinion, and I will try to show you later, that disinflationary or even deflationary pressures back in the global financial crisis years, in the aftermath of the crisis. What explained deflation was not the increase in the monetary base, but the decrease in broad money at that time. This pattern has not been the same in the current crisis, not at all. So here you have data on nominal GDP in the US and broad money measured by M3 in the US in different time periods. So you have the overall average from the 1960s up to 2019 with a rather similar rate of growth of nominal GDP and broad money. The 9 years up to 2019, again, much lower rate of growth of broad money and much lower rate of growth of nominal GDP. And then you have the extraordinary rate of growth of money in the last year, 22.6%. That is very extraordinary as compared to the average of the previous 4 or 5 decades. So again, here you have the annual rate of growth of money, broad money, the red line, and the annualized rate in the last 3 months. So in the years of the global financial crisis, a fall in the rate of growth of broad money into the negative territory, therefore deflationary pressures in the market. Then QE started from 2010 to 2019, a period of monetary stability, around 4-5% rate of growth of money per year. And then even before COVID-19, we observed here at the Institute an increase in monetary growth in broad monetary growth in America. Obviously, was very much exceptional after March 2020, with an extraordinary rate of growth of money. As I said before, up to 25% on an annual basis last year, and with the latest data, 22.6%. So we can tell there is a difference now. As compared to the global financial crisis years, now broad money, bank deposits mainly, are indeed increasing. That's something that did not happen back in 2008 to 10. So what we do in the report is to provide a monetary explanation of inflation. We were aware that there are many other factors affecting inflation in the short term. So what we did is to concentrate on those medium to long-term factors explaining inflation. And we focused on broad money, changes in the amount of money, as one of the most determinant factors over the medium to long term. We used a very classical approach, which is Milton Friedman's approach to inflation over the medium to long term. So what we observed is that whenever there is an excess in money holdings by agents, companies, households, and financial corporations, whenever there is an excess in money holdings, what they try to do is to reallocate that excess of money in order to diversify their portfolio, so they can increase their holdings of equity, real estate, bonds. And by doing that, by increasing the demand of these other alternative assets, they will be increasing their price. So there is no coincidence in seeing this correlation between an increase in the amount of money, excessive money holdings throughout 2020, and asset price inflation in terms of, again, real estate and financial asset prices too. So that's something that is very well stated in monetary theory, and it was also observed in the data. The effects of these portfolio adjustments by different agents in the economy is, as I said, the increase in asset prices, and that will have 2 effects in the economy. The first identifiable direct effect is that firms will have a much stronger balance sheet. The value of their assets will be greater than before. They will be in a greater position to spend, to invest, to enlarge their production capacity, or even to hire whenever they can hire. An indirect effect is that with higher asset prices, agents in the end will increase the demand of goods and services via the wealth effect. Overall, and with a lag, of course, these will produce an increase in nominal spending and also ultimately an increase in CPI prices. This was the theoretical rationale that we adopted in the paper in order to anticipate inflationary effects coming from those extraordinary rates of growth of money since March 2020. However, these effects, as we know, they are not immediate. As I said, we concentrated on the medium to long-term effects of inflation, and there are lags in the transmission of these increases in money, in the amount of money, into spending and ultimately into prices. These lags very much depend on how close the economy is from its potential. The closer it is to the potential, the greater the duration and the intensity of inflation will be. But it may take, well, according to the evidence that we have, 2 to 3 quarters for the increase in the amount of money broadly defined to affect spending, and 4 to 5 quarters to affect finally prices. This is one of the slides that I borrowed from one of my colleagues here at the Institute, from Tim Condon, in his one of his master's course presentation. This is the US household wealth at the end of 2016, distributed among different assets. So we have the orange area that corresponds to money. 10.5% of total wealth is in the form of cash. But then, as you can tell, there are many other alternative assets they put their wealth on. So 24% real estate, 21% equity, another 21% life and pension assets, and many others. Bonds, 4%. So what we describe in the paper is that whenever these 10% cash holdings goes up to, I don't know, 15 or 20% for extraordinary reasons, there is an excess in money holdings. Families and companies are not going to hold forever. What they will try to do over time is to reallocate that excess in the amount of money over or across other assets. That's precisely what we describe in the paper. And by doing that they will be increasing the prices of all those other assets. Here you have some data about how extraordinary money holdings, the increase in money holdings, have been in the last few months. I went back to 2007 to compare what happened back in the global financial years, global financial crisis years, versus the present crisis. So at the time of the global financial crisis, 2008 and even up to 10, we had an increase, an extraordinary increase in money holdings by domestic financial sector companies. At that time, QE very much was reflected in an increase in bank reserves at the central bank. That's what this line is reflecting, the red line. But money holdings by the other agents in the economy, households, blue line, and non-financial sector companies, they did not increase, not as much as financial sector holdings. As comparing these figures with the latest COVID-19 crisis figures, we can tell now that all money holdings by all sectors in the economy have very much increased in the last few months. So it's an extraordinary rate of growth by banks, but also by non-financial corporations and also by families. Up to more than 40% rates of growth for banks and non-financial sector companies, and also quite substantial increases in the households, families sectors, so up to 20%. So indeed, there has been an excess in money holdings accumulated in March 2020. And this refers to the US, but to a lesser extent can be applied to other leading economies as well. And the question that we ask ourselves is whether these excesses in money holdings by different sectors were going to be permanent. Do people want to hold an excess in money, companies as well, forever? Or will they get rid of it as if it were eventually? Well, here we have data for the USA. So this is the ratio of money held to household net worth as a percentage from 1945 to 2019, if I remember well. So over 7 decades. So as you can tell, even though it varies, obviously, over time, what families want to hold in the form of money is very much, is quite stable for such a long period of time. It varies from 10 to perhaps 17%. But permanently, I wouldn't say that they want to hold an excess in cash in their portfolios. That ratio is very much quite stable over time. Of course, as I said, there are changes in the short term, but over time is quite stable. And here we have two more pieces of evidence about that. On the left-hand side, we have the histogram of changes in money velocity in the USA from 1959 to 2019, very much displaying all the characteristics of a normal distribution. And on the right-hand side, we have just the plotting of the changes in money velocity in the USA in the same time period. Again, just referring to the USA economy. And as we can tell on the right-hand side chart, yes, there are changes in money velocity, in the demand for money. Yeah, there are, but they are not permanent. Over time, there seems to be a mean reverting property here. So what we can imply from these figures is that after a period of extraordinary fall in money velocity, such as what followed the announcements of the lockdown measures in March 2020, there will come a period of extraordinary increase in money velocity. So the more open the economy is to go back to normal business, then the quicker, will be the return to much more moderate money velocity figures. That means people will try to spend that money. And what we anticipated in that report is that that will come whenever the health issues regarding the spread out of the COVID-19 were much more under control than we are seeing, at least in the UK and the US, very much since the spring this year. So again, we based our analysis on the quantity theory of money. But, well, very simply put, as you know, on the left-hand side of the equation, you have the total amount of money times V for the velocity of money equals this right-hand side of the equation, P for the price level times T for total transactions in the economy. Well, what we argue is that it's much better to use the total amount of money broadly measured as a proxy of M rather than a narrow definition of money. If we want to explain what's going on with inflation, we should be using a broad measure of money, M3 in the US or M4 in the UK or M3 in the Eurozone, for example. Money velocity should be determined outside the quantity theory of money. Other one is just a truism. So if we want to make it a theory, we need to study the determinants of money velocity outside the quantity theory of money. And again, as regards P, the price level, we considered all prices, not just CPI prices. As regards T, we consider total transactions in the market, but not just the GDP. The quantity theory of money is usually questioned because of, in my opinion, two very common misconceptions, if I may say, about the quantity theory of money. One is that the quantity theory of money doesn't work because V is not fixed. Well, we're not saying that V, the money velocity, should be fixed. It is not. It does change. What we say is that changes in the money velocity are very much predictable. In normal times, they change at a stable pattern, and in extraordinary times, such as a crisis, we don't know how much is going to change, but we know that it will revert to normal after a certain period of time. Again, M should be defined not as a narrow definition of money. That is not going to explain inflation, but very much defined as a broader definition of money, including bank deposits. Those are the caveats that we made in the report in order to assess how changes in the amount of money would impact spending and inflation. And we used some examples for the US economy, for example. So if we take the trend growth rate of real output in the USA to be around 2.5% a year, and an inflation target of 2%, the rate of growth of money, broad money in the US, compatible with price stability, would be in the region of 4.5% and 5.5%. What we saw since March 2020 is that broad money grew at double-digit rates of growth. Again, 25% at the highest I think it was in the spring last year, and at the moment 22%. That's 4 times higher, 3 to 4 times higher than the reference used to determine the rate of growth of money compatible with price stability. That's why we very much said in our report that the rates of growth of money at that time in the US were not compatible with price stability in the US economy over the medium to long term. And we added a couple of caveats to our analysis. One of them is that what we were explaining were changes in the price level over the medium to long term. And we acknowledged that there were many other factors affecting inflation in the short term. And we did not say that the quantitative of money is tantamount to monetary neutrality. Not at all. We acknowledge that changes in the amount of money do produce changes in relative prices, in investment decisions, and it does affect the economy in real terms. So we're not just saying that we hold monetary neutrality as a sort of a creed. That's not what we do. We do acknowledge that changes in the amount of money do have an impact in the structure of the production in the economy. So which are the policy implications of our analysis? Well, the first and most immediate implication that we stated at the time, and it wasn't easy to say that back in the spring last year, is that the extraordinary rate of growth in the amount of money, broadly defined, since March 2020 in the USA, but also in other leading economies, was going to be inflationary over 1 to 2 years. So if the rate of growth of money on average stays around 10 to 15% over 2 to 3 years, up to 2022, average CPI inflation will likely be significantly higher than the Fed's target. How much higher? We even suggested in the report that between 5 and 10% between 2021 and 2022. But of course, we don't know that figure for sure. All we can say that is that the final impact of the monetization, of enlarged deficits by governments will depend very much on the reaction of the Federal Reserve and other central banks to the increase in inflation in the next few months. So how sustained inflation will be will very much depend on the reaction of the regulators, of monetary policymakers, to the increase in inflation in the next, in the second half of 2021 and the first half of 2022. And with that, I'm more than happy to take your questions and engage in discussion with the audience.
Thank you very much, Juan, for a very provocative presentation, provocative ideas, and also for presenting the work very, very clearly.